Good morning. It's Tuesday, April 7. This is episode 2 of Three Clowns. I'm Alex. With me, Tom, who covers tech and the growth names, AI, semis, anything with a chip. And Ray, who watches the Fed and everything underneath the market. Rates, macro, inflation. Good to have you with us.
Morning. Yeah, still here. Let's see what's broken today.
Morning, guys. Tom, you sound like you've been staring at pre-market futures for too long already, man. Give it a minute. Good to be here, Alex. Ready to dig into some of this beautiful, messy data.
I like that Ray still thinks this is going to get more organized over time. That's cute. Also, for the record, the bagpipes were culturally important. I won't be rushed on that. And I stand by the artistic choice.
Oh man, artistic choice is one way to put it. I think my neighbors probably have a different word for it, but I love the commitment, Tom. Keep it weird.
All right. Oil up a third day. Iran deadlines, Saudi premiums, Ukraine drones all at once. Banks had a strong session on higher for longer. Jamie Dimon dropped the annual letter, thoughts on AI and private credit. Crypto caught a bid. And Tom, Tesla at 352 pre-market. Your call is due today.
Yeah, it's a weirdly consistent story if you squint at it long enough. Oil is screaming something is about to break, and equities are going, yeah, but not earnings. Saudi tightens pricing, Ukraine takes barrels offline. Now you've got Hormuz being used as a negotiating tactic. That's 3 different supply constraints, different flavors, same direction, higher input costs. And the market just puts it in the manageable inconvenience drawer. That's the belief system. AI productivity in the future is apparently worth more than actual energy costs in the present. Which is fine, if nothing ever compounds negatively. The crypto versus gold thing is cleaner than people want to admit. Gold is for fear, crypto is for liquidity, and right now nobody's actually afraid. They just want exposure to things that move. Dimon warning about private credit while banks rally. That's just the market deciding the problem belongs to someone else. Losses will be larger than expected, but not, crucially, our losses. Thank you, Jamie. Stock up 1%. And Tesla at 352. That stock now trades like a referendum on belief itself, not a car company. Which is consistent with everything else we just said.
Oh man, the manageable inconvenience drawer. I love that, Tom, but I think that drawer is actually starting to catch fire. We've got oil climbing for 3 straight days right as we're staring down the barrel of Friday's CPI print. And that is basically the nightmare scenario for a Fed that's trying to find a reason to ease up. It's weird. Usually when you hear Hormuz and deadline in the same breath, gold is the first thing people grab. But the fact that it's just sitting there while crypto rips tells me the market isn't actually scared. It's just thirsty for liquidity. Alex, can you pull the 10-year for me from around that hawkish Fed comment yesterday? It feels like investors are reading Dimon's letter and only seeing the higher margins part, totally ignoring the footnote where he says private credit losses are going to be a disaster. We're watching a game of chicken between energy prices and the no-landing narrative, and Friday is the moment we find out if the Fed actually has any brakes left.
10-year was at 433 into the close. Came off its highs in the afternoon but stayed well above 4. Yields are sticky up here.
Yeah, the drawer's warm. It's just not a surprise fire. The market's fully aware oil and yields are creeping up. It's just making a very explicit bet that AI-driven productivity outruns input costs before margins crack. That's why Friday matters. It's the first data point that can actually tell you which story is winning. If CPI's hot, you don't get a slow rethink. You get a very fast one.
Quick one before we get into the tape. You mentioned banks had a strong day. Someone listening is going to ask, why are higher rates good for banks? Walk them through it.
It's the ultimate lag play, Alex. See, banks are incredibly fast at raising the interest they charge you for a mortgage or a car loan the second the Fed moves. But they are famously slow, like glacier slow, at raising the interest they actually pay you on your savings account. That gap between what they charge and what they pay out is what they call the net interest margin. And as long as they can keep your deposit rate low while your loan rate stays high, they're just printing money on the difference.
Gold's at 429 pre-market, up 0.5% this morning, finding its feet after yesterday's drop, but it still didn't move the way you'd expect when Hormuz is in the headline. All right, The setup's on the table. The tape is up next. All right, the tape. Yesterday's session in one sentence. The market decided energy costs are someone else's problem and kept buying. SPY up almost 0.5%, energy led, banks followed, tech held. Let's go through it. Oil first because it was the story. USO up 0.75% yesterday, up another percent pre-market this morning. Three separate headlines all pointing the same direction. Saudi Arabia charges a record premium on its crude. Ukraine drones hit Russian oil export infrastructure. And the White House is now threatening civilian targets over the Hormuz standoff. Tom, 3 supply shocks in one session. What does that actually mean for the market?
There are 3 different pipes getting squeezed at the same time. Saudi raises the price on what it sells. That's OPEC saying we have pricing power. Ukraine hits Russian infrastructure. That's physical barrels maybe not making it out. And Hormuz is the big one. That's not supply reduced. That's supply at risk of just not moving. Same direction, different mechanisms, so the market can't handwave it as one-off noise. Oil is basically a tax on everything. Moving goods, making goods, even running a data center quietly in the background. So higher oil bleeds into inflation whether you like it or not. And yet stocks went up, because the market's making a very specific bet, that this is a contained energy squeeze, not a demand killer, and that AI-led growth is strong enough to absorb higher input costs without margins collapsing. Energy stocks go up because they literally sell the thing getting more expensive. The rest of the market going up is a bit more optimistic. It only works if oil stops being a spike and doesn't become a trend.
Yeah, Tom. The manageable inconvenience is starting to look like a full-blown migraine when you look at what the bond market is doing. That 10-year creeping up to 4.33% is the market basically admitting that higher for longer isn't just a threat anymore. It's the math. Because you can't have oil climbing 3 straight days and expect the Fed to find an excuse to ease up. It's a total nightmare scenario heading into Friday's CPI print. Because if that inflation number comes in hot on the back of these energy costs, the Fed is effectively boxed in, and suddenly that no-landing dream starts to look like a very hard landing for anyone needing a mortgage or a business loan. It's honestly wild to see financials rallying on those higher interest margins, while everyone just ignores the footnote in Jamie Dimon's letter about private credit losses being way worse than we think. We're basically cheering for the bank's short-term profit gap, while the actual foundation of the credit market is starting to groan under the weight of these yields.
Yeah, it's not denial, it's sequencing. The market's saying margins expand now, losses show up later, and in between AI fixes the economy like a software patch. That's the whole trade. Pull forward the benefit, push out the damage, hope productivity outruns the math. Which is a great plan structurally, as long as time continues to cooperate.
Okay, crypto. BTC up almost 4% yesterday, ETHing up 420, coin up 2, MSTR up 6.5. Tom, same risk on logic or something else?
It's basically a nothing to fear today trade. No data, no immediate policy risk, so people reach for the fastest horse, and that's crypto. Oil and yields creeping up should, in theory, choke this, but the market just shelves that as a Friday problem and rents beta for the day. MSTR's the clean example. It's not a company anymore. It's a leveraged wrapper on Bitcoin sentiment. So BTC plus 4% turns into equity plus 6, plus 7, because the balance sheet is just stuffed with it. This all works beautifully right up until yields matter again, which they always do, usually all at once.
And AMC, up 12.5%. No news, no catalyst. Just retail finding something that moves on a risk-on day. Ray, close out the tape. One thing to hold on to going into this week.
Yeah, it really feels like the market has decided to put on its blinders and just bet that AI productivity is going to outpace these rising energy costs before they can actually hurt the bottom line. Friday's CPI is going to be the first real show-me moment for that trade. But the most telling thing is that gold didn't even flinch yesterday, which tells you that for all the headlines about Hormuz and drone strikes, nobody is actually running for the exits yet. So keep an eye on that gold price. If it starts to catch up to the oil move later this week, that's when you know the manageable inconvenience is turning into a real problem.
That's the tape. Footnotes up next. The footnotes. 3 things that didn't make the main tape but matter. Trump threatening civilian targets over Hormuz. Gold not moving when it should have. And Jamie Dimon's private credit warning buried in the annual letter. Ray, your section, take it.
Yeah, Alex. Let's get into the fine print, because that's where the real story lives. First off, the Hormuz threat is huge because that strait is basically the carotid artery of the global energy market. We're talking 20% of the world's daily oil supply squeezed through a gap that's only 21 miles wide at its narrowest point. When you hear talk about civilian targets, the market isn't just worried about a price hike. It's worried about a total physical blockage where tankers literally can't move. And since there's no plan B route for that much volume, you'd see oil prices decouple from reality almost overnight. Now, the weird part is, gold actually closed down nearly 0.5% yesterday while all this was swirling, which tells me the market either thinks this is just more geopolitical theater or, well, it's possible that crypto is starting to cannibalize gold's fear premium as a hedge. Gold is trying to catch up this morning, up about 0.48%, but that delay is a massive signal that the old-school safety trade is getting a bit dusty. And then you have Jamie Dimon's annual letter. Man, people are cheering the bank stock rally, but Jamie is pointing right at private credit and saying the losses there are going to be larger than feared. We have to remember that even though private credit happens off the big banks' books, it's all interconnected through the same ecosystem. So if those private lenders start seeing defaults, that stress eventually bleeds back into the banking system through counterparty risk. It's like seeing a crack in the foundation of the house next door and thinking your own walls are safe. Spoiler alert, they aren't.
Hormuz is the cleanest example of the market doing expected value math and just ignoring the distribution. Low probability, fine, but the payoff is absurd. If that strait actually closes, you're not talking about oil up 8%. You're talking about a step change where pricing just gaps to whatever clears the market, because 20% of supply is suddenly theoretical. And equities are treating that like a rounding error because it hasn't happened yet. That's not risk management. That's hope with a spreadsheet. Private credit is the one that actually bleeds into my world. A lot of that money funded late-stage tech, roll-ups, levered AI-adjacent bets that needed cheap capital to make the model work. If that refinance window shuts or defaults tick up, it's not some contained shadow banking issue. It hits multiples, hiring, CapEx, all the stuff people are currently extrapolating in straight lines. The uncomfortable part is both trades. Ignore tail risk in oil, ignore credit risk in tech. Rely on nothing breaking at the same time.
Yeah, it's like we're all holding our breath and just hoping the air doesn't run out before we reach the surface. We've basically built this massive perfection trade where oil has to stay high enough to keep the energy sector happy, but low enough to avoid a CPI nightmare, all while we pretend Jamie Dimon's credit warnings are just a polite suggestion. It all hinges on the idea that these risks won't collide, but Friday's inflation data is the first real test of whether the world is actually going to stay that cooperative for us.
Nerd Corner up next. Tom's section. Nerd Corner. Tom's section. And today we have something worth actually reading. Jamie Dimon's annual letter. Most people saw the headline about private credit. Tom read the AI section. Tom, what does he actually say, and why does it matter?
Yeah, so the important part of Dimon's letter isn't AI is risky. It's that he's the one saying it. This isn't some VC trying to sound thoughtful. This is the guy sitting on top of the largest balance sheet in the country, watching where loans are actually going, who's drawing them, and what they're being used for. So when he talks about AI, he's not predicting the future. He's describing the present tense flow of money. And what he's basically saying is, yes, this is real. This is probably as big as everyone thinks, but the capital has shown up before the returns. That's the mismatch. You've got billions going into data centers, chips, model training, entire companies built on expected AI revenue, and the revenue curve is still early. Not wrong, just early. And private credit is the bridge that funded that gap. All those "we'll refinance when cash flows show up" assumptions are sitting there waiting for an outcome that hasn't happened yet. So if that timeline slips, not fails, just slips, you don't get a technological crisis, you get a financing problem. And that's where it feeds back into equities, because the public market is pricing the end state. AI everywhere, margins up, productivity boom, while the credit market is exposed to the journey getting there. I agree with him basically. Long-term, this is real. But in the meantime, we've probably pulled forward a couple years of optimism and stapled leverage to it. Which is fine, if the timeline behaves.
You nailed it, Tom. And that journey is exactly where the macro ghosts live. It's such a classic echo of the dot-com era, where the technology, the internet, was absolutely real and did change the world. But the capital arrived a decade before the actual cash flows did. And that gap is where trillions just evaporated. The scary part for me is that back then, or even during the last decade of tech runs, you could afford to be early because money was basically free. But at a 5.33% Fed funds rate, waiting for the future is a very expensive line item on a balance sheet. I think that's what's making the Fed so nervous. They've seen this movie before, where the productivity promise is used to justify massive leverage. And when that timeline slips by even 6 months, the interest expense starts eating the house.
Yeah, it rhymes, but it's not Pets.com with a Super Bowl ad and no revenue. These guys are printing cash now. The risk isn't, does the business exist? It's, did you just prepay 10 years of perfection at 35 times earnings? Subtle difference. Financially quite important.
The calls are next. All right, the calls. Tom, before the new ones, your Tesla call from yesterday. 3:50 by late morning, due today. It's sitting at 3:52 pre-market. Market hasn't opened yet. Where are we?
Yeah, it's basically sitting on the line, which is exactly where these things like to get weird. Pre-market tagging 352 doesn't count. 350 is still the tell once real liquidity shows up. If it holds above with actual buying, fine. If it wobbles around there, that's the unconvincing part I was talking about. We'll know by the close.
We'll have the verdict in episode 3. All right, new calls. Tom, you first.
My call. Nvidia trades down 8 to 10% from here by early next week if CPI comes in hot on Friday. Not because anything breaks in AI, just because the entire trade is priced on duration. You're paying today for cash flows way out there, and a higher inflation print pushes yields up, which mechanically compresses that multiple. The belief doesn't change, the discount rate does, and that's enough. Which is awkward when you're valued on perfection showing up on time.
Ray.
My call is that the 10-year yield punches through 4.5% by the time we wrap up next week's inflation data, because the market is finally waking up to the fact that no landing is just a polite word for an inflation rebound. You can't have record Saudi premiums and drone strikes on refineries without it forcing the bond market to bake in a permanent risk premium that the Fed simply can't ignore. We've spent months pretending oil is a sideshow, but as the Hormuz deadlines get real, the term premium on those long-dated treasuries is going to come roaring back to reflect a world where energy costs stay sticky and the Fed is effectively trapped.
Mine. Gold catches the oil move by Friday close. It's up 0.5% pre-market already. I think the delayed haven bid finally shows up once the market has a full week of Iran headlines plus a CPI print to stare at. If oil's at this level on Friday and gold is still flat, then Ray's right that something's genuinely broken in the old hedging playbook. But I think it catches up.
I half buy it. Gold's supposed to react to fear, not just headlines. And right now the market's reading this as annoying, not destabilizing. If CPI forces yields up again, gold catching up gets a lot harder, not easier.
Well, I actually think it's the opposite. If those yields keep climbing toward that 4.5% mark I've been watching, it means the inflation signal is finally getting too loud to ignore. And that's exactly when people stop treating gold like a pet rock and start treating it like a life raft.
Tom versus Ray on the gold call. We'll find out Friday. Scoreboard. Tom has Tesla still live at 352. Ray has core CPI due the 11th, and now we've added 3 more. That's it for episode 2. Thanks for being here. We're back tomorrow before the open.